talk about what this all means for things like interest rates. Ian Lyngen is a managing director and head of U.S. rate strategy at BMO Capital Markets. He joins us now. Ian, there's a lot of information here. It's enough to make your head spin. At the end of the day, is inflation something that is going to prove challenging, or is there a path towards easing inflation pressures here?
Well, I think that that's the biggest question at the moment. It already has, to some extent, proved a bit more challenging than the Fed was anticipating that it would. Recall that the first quarter's data came in suggesting that inflation is a bit stickier, but that doesn't mean that progress has been reversed, simply stalled, at least until we have tomorrow's numbers in hand. And I do think your observation about the PPI data being somewhat mixed is a perfect one, because that's the type of confusing and conflicting situation that the Fed has been facing throughout much of 2024.
I mean, it did seem like in the markets, people were almost keying into that comment from Powell and saying, okay, well, that should be a quote unquote good sign for what to be watching for in the CPI data tomorrow. What are you going to be watching for in the consumer prices for the U.S.?
So I think that the most important aspect of CPI tomorrow is the super core measure, which is core services excluding shelter. That has printed higher than anticipated each of the last 3 months, and that has the highest correlation with nominal wage growth. And that's what the Fed is truly worried about at this stage. Now, obviously, there's been a lot of talk about shelter inflation and housing prices remaining sticky, and that's not going away anytime soon, but it's that wage inflation spiral that the Fed is trying to avoid.
So when you think about what happens with interest rates in the United States, what's your current expectation for 2024?
We think that over the course of the next several months, we will see that monetary policy works. It works with a lag, and eventually inflation is going to come back in line with what the Fed wants to see. They'll start rate cuts by the end of the year. Maybe we get 1 or 2, and we have 10-year yields forecast to end 2024 at 4%, and the curve steadily move back into positive territory.
And so what is your rates team advising clients at BMO how to position in the market given that expectation?
So as a general theme, levels in the front end of the market, the 2-year yield in particular, is going to be attractive if we get closer to 5%, but scaling further out the curve is going to become thematic over the course of the year. We do not like the higher break-even trade. We think that the Fed credibility trade in this environment is lower break-evens, and that suggests we will ultimately get that reinversion of the curve led by the 2-year sector. So we like the front end of the curve.
Ian, we've got all this going on as out of the blue, a meme stock rally has emerged. And we spoke to a guest earlier who said on the margins, that might actually just speak to the fact that there is a reasonable amount of confidence out there. I guess that's one anecdote we can try to measure. We certainly try to measure the health of consumers right now. We had a conversation earlier in the program about savings levels in American households right now. I mean, when you put it all together and your prediction is that eventually this year we'll start to see rate cuts, where do you see, when we walk away from 2024, what kind of U.S. economy do you think we will have looked at in 2024?
I think that at the end of the day, it comes down to whether or not Powell and the Fed have the ability to start normalizing rates, because if inflation proves too sticky, the longer the Fed stays at terminal, the higher the probability that households are going to begin to feel the strain and that we see a more dire economic outcome. In an ideal world, and this is the one that Powell is hoping for, we can start the process of normalizing rates lower. That's a boost to confidence. That's a boost to risk assets in the equity market. And we come out of this year seeing as under the impression that the real economy offered that soft landing that we've all been looking for.